shrinkage.
What comes to mind is not something I'm going to talk about here on this particular show. That might be for an evening hour one night.
And the reason we're bringing it up is because Dick's was just the latest example today.
Dick's was a good example of the shrinkage. Got it. Hey everybody, JC Peretz here, founder of AllStarCharts.com, and welcome back to Pardon the Price Action. I am joined by Steve Straza, who is now, 3 weeks in a row? Straza back from Asia. Nice to be back in America.
At least two. Yeah.
At least two. Well, already going back to Vietnam, already plans to go back to Asia. But while we have him here in the States, welcome back to PTPA. And I say we get right into it. Mr. Straza, everyone, quote unquote, everyone is talking about uranium stocks these days. Do you think the recent relative strength from this group is sustainable? Is everyone talking about uranium?
What, are you not? Are you not a part of this party yet? All right. Well,
because I talked to you.
So, we were talking on the morning show this morning. While there are a lot of different funds, there's a number of ETFs. I actually just deleted one. There's a junior uranium miners ETF, URNJ. We're not even going to talk about it because
high quality stuff there in that junior uranium ETF.
Right. Like you said, some of these funds are so illiquid, we can simply use them for information, right? So URA is the one that you can actually invest in because it has the volume that you'll need. But look at the structure here. It's a big base. It's a base on top of a base. And I'm really interested in NLR, 2 charts down. The next one. Yeah. Look at this massive base, really resolving higher, decisively just the past few weeks. I think, it's a bull market for these uranium stocks. We got to be looking under the hood for some of the best names.
Well, you can't trade NLR, so keep that in the back of your mind because it's not liquid. So what we do with these scenarios, and by the way, there's a lot of scenarios like this where there's a very interesting ETF and sort of the way it's constructed, but it's not liquid enough to trade. I think this thing only has 70 million in assets, trades 16,000 shares a day. So there's nothing there. But what we like to do is look underneath the surface at how it's built and what's in it. You got Constellation Energy, CEG, PEG, Cameco. So you got a combination of utilities in there. So it's an interesting play on nuclear for sure. You're looking for specific names. Cameco is the big one. They're the industry leader. Look at the relative trend. Not only is Cameco breaking out of a massive base like NLR, look at it on a relative basis. I really like that. And then one more I just have to mention. Everybody's always looking for like the picks and axes or the nuts and bolts play in an industry. This BWX Technologies, they make nuclear components, sell them to the government and sell them to different nuclear plants and uranium companies. We're above 72. This is a beautiful chart. And we currently are, and it's been finding support this week. So, all right, next topic. All right, value outperformed for about 1 month, but tech and growth are hanging in there. What are the relative trends telling you about how to be positioned in the second half? Well, so far, it continues to be technology really being struggle city is really what it is. So even coming into the back half of the year, I'm looking at what some of the other sectors look like relative to technology. So if technology is going to underperform, as it runs into those former highs from late 2021, it's going to be hard for the S&P 500 to go further. So then it becomes a situation of looking for maybe sectors like energy, let's just say, on an absolute basis that can do well, even if the overall indexes aren't. And then relative, like some of the other cyclical areas like financials and industrials, are we going to see rotation into those other areas, which, by the way, is perfectly consistent with how a bull market progresses. You get that sector rotation. You might not see much improvement at the index level in that sort of environment, but the rotation is certainly there. So that's sort of what we've been looking for. It's kind of playing out that way, right? I guess you could say it has. Has it though? Like we got a little bit of rotation into these names. They had a couple good weeks on a relative basis, but it's really cooled off. And if you look at the absolute trends, like that dual pane chart of XLI and XLK, I think what bulls were hoping for was that energy and these other cyclical and value groups would really pick up the slack with the selling pressure accelerating in tech and growth. But when I look at these charts and all the other, sector spiders, they're all below overhead supply, and none of them look that good on an absolute basis right now. Well, energy's making new 3-month highs relative to the overall market and tech. So there has been some strength there. And then on an absolute basis, technology under, kind of struggling below that overhead supply makes perfect sense. I get it.
I wouldn't throw your tech stocks out here.
I don't own any tech stocks, so I have nothing to throw out. All right. So, Mr. Straza, moving right along. We both like energy here, do we? What are the levels you're watching?
Do you not like energy? Should I change the question?
Oh, I do. I didn't know that you were such a big traditional oil and gas, I should say, not uranium, of course.
No, but on that note, I was going to save this for the end, but we'll just start here. I think, yes, energy, had a huge trend higher off the COVID lows. Then it's gone sideways for a year or two now, depending on what subgroup you're looking at. We break out of these ranges. Yeah, totally looking for another leg higher from the whole sector. But I think the best trades and the best longs will be in these ancillary energy spaces like uranium and like coal. I think that's what it's going to be.
Interesting. Some of the oil services, right? Schlumberger. Not to let the cat out of the hat just yet, but Strass and I are working on a new Dow Jones Industrial Average. Are we allowed to tell people? We're working on. By the way, we're adding Schlumberger. I just kind of threw that out there. You agree on that? We should, right?
Yeah, I don't know if they definitely made it. We gotta look a little bit. Is Halliburton,
Marathon Petroleum, maybe Marathon? These things, continue to make new highs. Look at some of these MLPs. We talked about them today. Energy Transfer, big insider transaction by their chairman, 38 million, but he's worth 5 billion. So is it really that much? Nevertheless, 38 million pays a very handsome yield. This is price only. If you add the dividends and look at the total return, it looks much better with that 10% yield, as you can imagine, compounding over the years. So if this thing starts taking out 14 on the ET, really, really interesting on the MLPs. Really interesting.
The more I look at some of these pipeline companies, the more I like them. But again, I would say look at coal, look at uranium. We just talked about uranium. And in coal, I really like AMR and CEIX. Both are breaking out to new highs.
All right, let's talk crypto.
Yeah, wow, huh? So following record low volatility, talked all about it, Bitcoin just made a big move. Where does the cryptocurrency go from here?
Well, it's been going lower so far, so let's see. Nevertheless, we have seen that volatility coming back. I think the stat was the Bollinger Bands were as narrow as they've ever been, ever. So, yes. One thing we know about asset prices is that asset prices trend, and volatility, on the other hand, mean reverts. So from volatility contraction, we were looking for that expansion, and we have certainly seen that. Now, volatility is price agnostic, so just because volatility expands doesn't mean prices necessarily need to go up or down, but chances are one of those two. And in this case, so far, it's been down with that expansion and volatility, which I suppose is perfectly normal. Could have gone either way. So now here we are, big level, 25,000. That was former resistance. We've been eyeing this level for a long time. I know you have. It's messy at best, disgusting at worst. It's got work to do. Can they dig in here and find support? Sure. They could just as easily break down to 20. And it wouldn't surprise me one bit. But let's just reiterate where this is happening, Straza. This is Bitcoin failing at former support and the same place that it failed at in the spring. So the market continues to prove that there's more supply than demand for Bitcoin at these prices. And until demand can absorb that supply, prices aren't going higher. So
it's a big area, right? Like holding 25 is one thing, but it's really got to get through 30. You did a good job there. I want to talk about this seasonality, right? I don't weigh seasonality too much, but we do look at it. We're always looking at the seasonal trends. This is interesting, JC, right? I had to zoom in on this one. From August 16th to August 19th, going back 11 years now, all of the price memory or price data that we have for Bitcoin, it averages a 6% sell-off in those 3 days. When did this big move coming out of that volatility contraction happen? August 16th, we sold off about 11, 12% in 2 days. And I thought that was too good. I had to talk about it.
That is interesting. Not surprising, obviously, from a seasonality standpoint. That's perfectly consistent. We saw a huge move out of the NASDAQ and technology in general, not followed up with Bitcoin prices higher, as you can see here. What are you thinking? Does the NASDAQ catch down to Bitcoin, or does Bitcoin play catch up? When
I see this, I think we've been waiting for Bitcoin to play catch up, Now we've had this weakness in stocks for a month now, and Bitcoin rolling over. Is it time for stocks to catch down? So if that's the case, it's a pretty big divergence here to clean up.
For sure. And let's remember longer term where we are. We're still above those prior cycles highs. So structurally, this is an uptrend. Intermediate term, this is a sideways to downtrend at best. And short term, this is definitely a sideways trend, potentially turning into a downtrend. So keep that in mind. And let's move on to real asset classes. Let's remember cryptocurrencies represent approximately $1 trillion worth of assets. A trillion and zero might as well be the same thing when you compare it to the bond market, pushing up against $140 trillion. This is the real market. And Mr. Straza, if interest rates were going to go, we got to ask the question. Straza, yields are making new highs across the board. What is the bond market telling us?
Look, for me, it's 4.4 and 4.3 if you go to the next chart in the 30 and the 10. We are now above there. I know a little bit of weakness today, giving some back, but it's not just the U.S. I just looked all through all of developed Europe, even Japan. JC, the 10-year is making new highs in Japan. 30 years not far behind. This is a synchronized global phenomenon. Rates are breaking out of their sideways ranges, which have persisted for almost a year now. And if all of these breakouts are valid, then you better believe the U.S. is going to follow.
If interest rates are going to go up so much higher, how come they can't even get overbought? I mean, what kind of weak ass bounce in rates is this when you're not even getting overbought conditions on the U.S. 10-year yield, Mr. Straza? Are you going to bet on this weakling? Are you going to bet on this runt of the litter of rallies in interest rates? Or are you going to place your bets, Mr. Straza, on something perhaps showing more strength and power and authority, which this is lacking tremendously? Meanwhile, large speculators have on their largest net short position in the bond market ever.
Yep.
And that just doesn't sit tight with me being on their side. I started buying bonds on Friday. The trade is already working ever so slightly. And I might put on a big boy position. Not yet, but I might put on a big boy position.
Throw up the Q's TLT chart. Why don't you just make a pairs trade? You've been talking all this smack about tech stocks running into their former highs. Why don't you just go short the NASDAQ, buy your bonds, pairs trade, bet on this gap shrinking down?
I'll tell you why. Number one, I don't talk smack. I don't care whether it's at resistance or not. It doesn't matter to me at all. It's just a fact. I mean, and there's no smack. It's just basic arithmetic. Number one, if I wanted to short the NASDAQ, I would already be short the NASDAQ. I don't necessarily want to short the NASDAQ. I don't necessarily think it's a great short. Maybe it crashes. I don't know. It'll do so without me. I don't love that trade. If anything, I'd rather be patient and buy a breakout in the NASDAQ and technology, if anything. So I'll have to see that. But in the meantime, I see an opportunity to nibble a little bit on the bonds. It's a low probability of success trade. I know that going in. I'm a big boy. I can handle that. If it starts to work and we start creeping higher, and this is a failed breakout in rates, which it certainly smells like in my experience. It doesn't necessarily have to be that. Smells a little fishy to me. And if that's the case, my bond trade's going to work and I'm going to be adding to positions on the way up. And if I get stopped out and rates rip higher, then so be it. I'm okay with that. I've been wrong before. I'll be wrong again. I'm good.
Do you ever lose sleep at night thinking, not owning tech stocks, you could just be missing out on this like AI revolution that's taking place?
Absolutely not.
Nothing. All right.
Nothing. It's not nothing. Less than nothing. All right.
I heard
2-minute drill.
All right.
2-minute drill. You can talk to me, Mr. Are we doing word association first? All right. Well, Straza, have at it.
Come on now. You like this game. This is a game that we like to play where I'm going to throw out a word or a phrase. JC and I are going to say the first thing that comes to mind. Listen, we've been talking about earnings calls a lot lately. Shrinkage.
Well, what comes to mind is not something I'm going to talk about here on this particular show. That might be for an evening hour one night. I'm surprised. I learned that the shrinkage was so what word comes to mind? Words I'm not going to talk about. What I'm surprised most about is that this means that their items are being stolen from their stores, and that's why their earnings suck. Like, I think they're just making things up. And I'm not a fundamental analyst, thank the holy Lord. I'm not a sell side analyst either, so this means nothing to me. Again, thank the holy Lord. I think it's hilarious that their excuses, people are stealing things from their stores and that's why their earnings suck. Like, to me, it's comedy, I guess.
It's an excuse. And we see this like in different industry groups. I think like one company or one CFO will stumble upon like a really good excuse. And all of a sudden, like the whole industry, like all of the stock's peers will also be using the same excuses on their earnings calls. And right now it's shrinkage for the retailers. They're all talking about it. So, oh, well.
Dude, that is really funny. Like,
yeah. And the reason we're bringing it up is because Dick's was just the latest example today.
Oh, Dick's was a good example of the shrinkage.
Oh, God.
Got it.
Great.
There is not just overhead supply for stocks and indexes in the United States. This is a global theme, Mr. Straza. Let's talk about some of the patterns and levels that we're watching overseas.
Yeah. So, something like emerging markets, this would be one of the lagging indexes from an international standpoint, right? Still building out that base, still working on that reversal pattern. We've seen a million of these patterns resolve higher already this year. They still have not been able to get it done, right? This reminds me of something like the Russell 2000 in the US, right? So we need to see these reversal patterns break higher. When we look at some of the leaders, if you go two charts down to UK and Italy, running into a shelf of former highs. And these are some of the leaders, right? Developed Europe, Germany would also fit that bill. And they're all just running into former highs, backing off. So very logical levels. And, how long this kind of corrective action takes time and how long it takes these groups to absorb this overhead supply before moving higher is anyone's best guess.
I want to skip down to Vietnam. Straz has been pounding the table about Vietnam since he got back. A little bit of a pullback last week here on the Vietnam ETF, but heck of a run off the lows, right?
It's been really small market stuff like Qatar, Vietnam, much smaller international ETFs that are doing okay. Vietnam is one of them, but it got blasted late last week, down like 6 or 7% in a single day. So catching lower to its peers. But yeah,
that's what these things do. But you're also seeing Canada selling off, running into those, that former resistance, right? Looks, messy like the S&P probably is probably a good comparison here. We tend to not compare the behavior of the S&P and Canada because they look similar, but usually because of how different they look, in fact. But in this case, they're actually trading together, right?
And, Canada is full of the kind of stocks that are kind of doing the best over the short term, right? Canada's got a ton of energy, financials, these groups that are supposed to be leading or have been leading, at least over the past few weeks, still can't get it done. Kind of speaks to that broader point of none of these groups are really working on an absolute basis so good right now.
Yeah, eyes on Latin America, long-term downtrend. This thing's been going from the upper left to the lower right for a long, long time. If we're going to get that rotation, continued rotation into things like commodities and, natural resources, basic materials, energy, I would imagine that Latin America, which this is kind of like ex-Mexico, I would imagine Latin American stocks are going to start going from the lower left to the upper right, kind of like what we've seen over the last few years, but, kind of really get going and start making new highs. We start getting above, back into the mid 30s, start retesting those 2018, 2019 highs. Now we're talking about a potentially massive bearish to bullish reversal, but this thing's got a lot of work to do, Straza.
Yep. And if you look at that relative trend real quick, right? So everything kind of below overhead supply on an absolute basis. This is the rest of the world versus the US. Starts getting
developed markets versus US.
It's the biggest markets around the world versus the US, right? Yeah. So we thought this reversal pattern was getting ready to go late last year, early this year, totally rolled over. Look, coming off of a decade and a half downtrend, it's going to take time to build this base before we reverse higher and have a sustainable uptrend for ex-US markets on a relative basis.
Right. All right, Straza, nice show today. Nice conversations. I thought we had some really interesting charts. We've been doing a lot of charting lately together. I missed you while you were gone. Why don't you tell me about your hot take for this show?
Listen, NVIDIA earnings. Everybody wants to talk about Jackson Hole at the end of this week. The big event this week is NVIDIA earnings, right? Their earnings reports for the past 2 quarters lit a fire under tech and growth stocks, right? There was a lot of sympathy trading on the back of NVIDIA. In other words, they put out a huge beat and huge guide for their AI business. And then all these stocks that aren't making any money off of AI yet started going up in tandem. If you own these stocks, you have to be mindful with NVIDIA coming out and reporting earnings again this quarter and expectations as high as they are. If, God forbid, they miss or announce something poorly, you now have downside risk, right? So if you enjoyed the upside from the sympathy trading with NVIDIA to the upside, you're going to have to take that risk to the downside now. So there's a lot of these AI stocks, some of the best tech stocks this year, that are probably going to trade in sympathy to NVIDIA's earnings this week.
All right, my hot take is that position sizing is more important than fundamental analysis. You can do all the fundamental analysis you want and drive yourself crazy. But the truth of the matter is that position sizing is really probably the most important thing. It lets you manage your own personal emotions, right? Because if you're not sleeping at night, you're too big, for example. Having positions responsibly sized allows you to let them dance. Right? Let the market do what the market does and, prevents you from getting shaken out too easily because maybe you got your stop too tight because you're too big and you can't afford to lose more than whatever it is. So position sizing is really, really important when it comes to the options market, using certain strategies that limit your risk. You know what you're willing to lose, as soon as you press the button and you're okay with that. So that's my hot take today. Position sizing, underrated, Straza, underrated.
I like how you mentioned options there, right? Because options can play into the decisions that you make about position sizing.
Yeah, there's a lot of strategies that cap your risk. There's a lot of strategies that also cap your upside, for example. But you're okay with that because maybe you're increasing your probabilities of success. But understanding what your risk is and being able to define that is most important. And then you can work your way backwards on the math. So that's my hot take. Everybody, thank you again for watching. Make sure to give us a like and hit the subscribe button so you never miss an update. And follow me at All Star Charts. Make sure to follow Steve at S Straza on Twitter. Leave a comment below. Let us know what you think. And we will see you next week.